And ladies and gentlemen, as we know, we're entering a crucial phase in India's economic story, where long-term growth potential is becoming increasingly evident. So our next session is going to dive into how the principles of value investing, which focus on finding undervalued assets, can be applied effectively to India's rapidly expanding market. So we already have with us Mr. Arun Chulani. Ladies and gentlemen, let me quickly introduce him to you. With over 20 years of experience in the investment world, he has an impressive track record. His deep expertise extends to working with sovereign wealth funds and top-tier financial institutions during his time at EY, where he was instrumental in building their debt and capital markets division in the Middle East. His insights will help us grasp how India's economic potential can be unlocked through the disciplined lens of value investing. Ladies and gentlemen, can we please extend a round of applause and welcome him in our midst, Mr. Arun Chulani. Welcome. That's your clicker. So this one is for to go ahead that way.
Hello. Thank you for having me. It's always interesting in finance. You always are learning something new. Well, as rightly said, my name is Arun Chulani. I'm a co-founder of First Water. And really, it's a case of so far, so good. Is this clear? Oh, great. So first of all, I'm just going to walk through how to be a value investor. But obviously, we have to walk through our credentials first. So essentially, who is First Water? So First Water has been one of the leading AIFs in India, at least on PMS AIF World. In the last year, we're up 73%, 51% on a 2-year, and 38% on a 3-year. But then everyone's a rock star today. Even my grandmother is telling me she's picked amazing stocks. So going further back, how we reacted to different market scenarios. We also have an FPI, which is about 6 years old. And that is also up 51% on a 1-year and 35% on a dollar basis on a 5-year. But even 5 years is a bit short. So if I go back even 20 years, we're actually led by a gentleman called Ricky Kirpalani, and he can be seen as a marquee investor in the Indian stock market. So prior to starting our funds, 2002 till 2017, we got Deloitte & Touche to review his track record. And they showed that he took a pool of capital from $3.15 million, from 15 CR, to $174 million in 15 years, and that over 1,100 crores. So that's a rupee CAGR over a long period of 33% and 73x. So that is really alpha. I mean, alpha has probably been mentioned a lot, and as of last year, it was in excess of 3,300, and that is organic growth. That is a multiple of 214 times. So a lot of people had 1 crore in 2002, but do they have in excess of 200 crores in the stock market? And that's also accounting for taking out $30 million. So this is, our fund is really built on him. He's really running the show. And our FPI, luckily, has been the winner of With Intelligence's India Fund of the Year. And so that's the story. So that's really who we are. So what is value investing? Investing is very much a philosophy. You know, it's always interesting to understand where's the momentum, where's the next big thing, is it AI, is it tech? But for us, it's very much centers around investment philosophy, because we're always going to experience cycles. You're going to have market cycles, business cycles, economic cycles, industry cycles, company cycles. And without a great philosophy, without that anchor, you're going to be awash. And even though everyone today is saying this is India's golden decade, everything is rosy, but who knows? You know, they've been saying the same thing in 21, in 17, in 2010, in 2007. So nothing moves up in a straight line. The market is violent. So just when you're complacent, when you're happy, it's there to make you pretty unhappy. And that's when people will say India's finished, the government's coalition, it won't work, the policies, high youth unemployment. But we know that India is experiencing long-term tailwinds, and that is what's pulling us. So effectively, how do you be a value investor knowing that centering yourself around this investment philosophy? So effectively, for us at least, we're value guys. So we try and find cheap stocks, things sitting under book, things under maybe 2 times book or around 10 times PE. But value investing is more than just looking at cigar butts and picking them up. For us, we are looking for a catalyst, and that's what you should be doing as value investors. Look for a catalyst that will unlock that value, an inflection point. And what do I mean by this? I'll go through some examples to kind of make it more tangible later, but it could be a government policy. In 2019, the government announced that they're going to spend $1.5 trillion in infra. That is an inflection. They followed up in 2021 with another $1.2 trillion. That's almost as big as India's GDP. So that is a real inflection. And who's going to build India? If we have these dreams of becoming the 3rd largest economy in the world, you know, the infrastructure has to be spot on. So it's going to be these companies that have endured 10 years of a very lean sector, all these EPC companies, and also the ancillaries. Also, what is another inflection? China +1, minus China, where China itself has done an economic miracle, but now they're labor uncompetitive. So in many industries, they have to reduce capacity. So as India, as still not in that position, we are labor competitive. And so hopefully that's where the volumes as well as the margins will come to us. So that's another inflection point. Other inflection points could be the turning of a business cycle. You know, just because India is going in a bull market, it doesn't really mean that all industries are. You've got chemicals, textiles, now steel, and flexible packaging. You know, different businesses can be undergoing their own personal bear market. So again, even in a market like this, where you have a bull market, there's still an opportunity to find value stocks. And that's really your job as a stock picker. You don't need 1,000, you just need a handful to create alpha. And of course, a concentrated approach. And what do I mean by this? If you really like a story, you want to take a big swing at it. You know, you can be in a mutual in 50, 60 stocks, but typically you want the risk reward in your favor. And if you think there's going to be a big upside, 100, 200, 300%, you might as well step up to the plate and knock it for 6. No point having 2% and 1% because it's not really going to make a difference in your portfolio. So position sizing as a value investor is also important. But what's also there, it's also important not to be that kind of buy and hold guy. You know, a lot of people will think, let me buy today and sell in 15 years. I'm enjoying the India story and being part of wealth creation. But active management is as important to creating alpha as is finding the right stock. And what do I mean by this? So for instance, the market doesn't mean that it'll all move up in a linear motion. And again, I'll show you an example where you can actively manage your portfolio to try and increase the alpha. Because when you put together a portfolio of, let's say, 35 different stocks, you don't know who's going to move up first, who's going to move down. And inevitably, in the short run, the market is a voting machine. Some will move up and some will move down. So here you have the opportunity to essentially trim your winners and buy into your laggards, because effectively the risk reward is now more into your favor. And here's where you can crunch in additional alpha. And effectively, this is what Ricky does. And of course, you have to be a patient and contrarian in nature. You know, those ones who are chasing momentum, chasing a quick buck, sometimes don't get it. But if you have the right philosophy, the right approach, then you will endure the violence of the market. And in our case, at least, we've been able to get that alpha by being patient and contrarian in nature. And of course, averaging. You know, some people will try and time the market. They'll say the market is high, 23, and so on. But first of all, as a stock picker, you've got to find just a handful. So for instance, even though we're up 73%, our price to book today is 1.6. So that's still relatively the cheap seats. And also that's one part of the active management. But what do I mean by averaging? Let me go back to that. So don't time the market. Put in a tranche. Because let's say at the beginning of 2023, we had Russia, geopolitics, interest rates, inflation, Credit Suisse had collapsed, SVB, you had a financial crisis. Everyone would have said then, let me reduce my positions. However, we see where we are today. So effectively, put in a tranche because the market can still easily move up. And just be disciplined in your approach, like a SIP investor. Because if the market keeps moving up and you haven't invested, then you will always be waiting for the correction. but you will have that confidence to continue averaging in and running with the market. Let's say the market falls, then you'll say, I've lost on my first tranche. But your second, your third, your fourth tranche is very much your weapon against downside volatility, because that's where you average your time in the market and you average your loss. So value investing is not just about finding below book value. It's very much a play in all 5, 6 factors where you can create your own alpha. And effectively do what you know. You know, everyone is running after the big themes, the high beta stocks, but here's not our space, at least. And it's very much do what you know. Because let's say an Amazon or Nvidia trading at 90 PE, 60 PE, it could be 50, it could be 60, it could be 80. That is not in your camp. But if you're around book value under 2, then very much you are not going to be at the mercy of re-rating of market perception, at least not as aggressively as these guys. And effectively, find sectors that you understand. So in our case, it's very much the industrials, the basics, steel, cement, plastics, packaging. You know, none of it is very interesting. In fact, it's very boring. But effectively, no one in the market is that much better than us in terms of understanding these businesses, because they're very basic. What does flexible packaging do? Essentially, it wraps your crisps, your chocolates, your meat, and your cheese that you buy in the supermarket. So it's very easy to understand what goes in. Polypropylene, what comes out is BOPP. So effectively, choose the sectors that you have a good handle of. Also, why do we at least choose to be in these types of businesses? Because it's easier to triangulate. You can triangulate when you have a business which has a high balance sheet. So if you said, how much does it cost to put up 1 million tons of steel capacity? It's about $1 billion. Suddenly, with 2 metrics, what do you have? You know what should be on its balance sheet. You know what its revenue capability is. And you can triangulate against its peers. The revenue per ton, margins per ton. So here, it's an easier way of understanding its intrinsic value, which is very important, effectively. Let me go through a case study. It's a bit small, so I'll just walk you through how do we put this in practice and how you can put this into practice. So what is Polyplex? Like I said, it's not a very interesting company. Many people don't imagine it changing the world, but in effect it has. So if you look at India's, let's say, consumption growth, everyone is very excited by FMCG companies, Unilever, Colgate, Procter & Gamble, but they're richly valued, 30, 50, 80 PE. But if you look across the value chain, what is growing as fast, if not in some cases faster than these businesses, is flexible packaging. And Polyplex is one of the alpha players in the space. Effectively, this company is in around 5 countries around the world, so it's geographically diversified. It was debt-free, and it had even at one point $150 million on the balance sheet. So it'll find it very hard to go bankrupt. And these are the kind of businesses you can find. And it's an alpha player in the space. So essentially, from 2002, when Ricky first identified it, it was less than 1% of market share globally. By 2010, it had carved out 7% of global market share. So this was an alpha player, a low-cost producer globally. And even, in fact, until 2019, you could buy this business than less than half of book value. So even though in India, this business is growing at 10 to 12% annually, the market wasn't recognizing this. So this is what I mean. It had a catalyst. What was the catalyst? It was overlooked growth. The market had effectively overlooked this. And Ricky liked this company so much, he bought 23% of the entire company. And his first purchase was at 4 rupees. And it actually went from 4 rupees, and in 2022, it went to 2,800 rupees. And that's excluding dividends. That's a 700x. This is not a Tesla we're talking about. This is not a Uber or a Zomato. This is a plastics packaging company. And even the fund, our AIF, bought into this. And at one point, it was around 9-10% of our book. And effectively, we timed it optimally. So this is what I mean, again, by active management. Had we had a buy and hold theory, we would have seen it go up from about 400 to 2,800. And earlier this year, it went back to 700. So we'd be nursing, even though we're up, we'd be nursing a fictional 2/3 loss. but we optimally exited and entered the business. So when it hit above 2,200, and this is the understanding of intrinsic value versus extrinsic. This is very important to optimally know when to, downsize your position. From 10-11%, we ramped it down to about 2% of our portfolio. So we creamed it and we've re-entered. In fact, our position, when we saw it come back to 700, we waited. And because we know this business, since it's easy, we've been in the business for 20 years, and that's what I mean, do what you know, that we felt the green shoots are coming, the margins are improving, the volumes are doing better, the realization is coming up, and we've ramped up our position at that initially 700s and now today it's around 1,200. So this is about biting this cherry or biting the apple twice from the same stock. So this is what you can do with active management in a liquid business. Another type of business that also shows how you can do it effectively, steel pipes. Again, no one is going to get too excited by the steel pipe industry. But what does it do? It does transportation, oil and gas, water, liquids. But it was in the dumps from 2013 till 2023. Effectively, for 10 years, had you bought this into this company, you'd be sitting and in semi-depression because the business hadn't gone anywhere too fast. But because there was overcapacity, there was a lack of infrastructure programs, and the oil and gas sector, which is one of its biggest customers, was in the dumps from 2015 since oil and gas prices had crashed. But effectively, we identified 4 catalysts on the horizon, and this is what you should be looking out for, the catalysts, the inflection points. And what were they? They were the Jal Jeevan mission, water for all. And what does this mean? Steel pipes. So that was a $73 billion program that's still ongoing. Gasification, this also means steel pipes, moving from 7% of India's energy mix to 15%. Again, a huge infrastructure program. And again, India's neighbor, Saudi Arabia, building mega developments, NEOM, the Red Sea development, mega conurbations, which needs water distribution. Again, steel pipes. And then the Eastern European conflict meant that oil and gas prices again went through the roof, and energy security was back on the agenda. Companies were exploring, pumping, transporting. So all these inflections came in. And this company, we identified 2 initially, Jindal SAW, Welspun Corp. Jindal SAW had a gross block of $2 billion, but was in the market for $1 billion. That was just like a song, and yet no one was identifying it. Very few were identifying this, but we built up a pretty decent sized position. And at around, in 2021, March, we identified it. It was sitting at 70 to 90 rupees. Welspun Corp was sitting at 145. Today, they're in excess of 700 rupees, and we've actually done better than that. And why is this? Because the market doesn't move up linearly. It didn't take the stocks up linearly. We redeployed between one and the other as one moved towards its intrinsic value against the other one. And here you could do better as an alpha creator, effectively. So the moral of the story is you are still able to find value investment stocks because of the differences, because some businesses are still in their bear market, and you're able to find that next wave of winners. You don't need too many. You need a handful, let's say 30, 35, and effectively, you should be looking out for the catalysts and really understanding your business. Do what you know. And I'd like to stop there for any questions. Anyone? Ah, great.
Thank you very much. Thank you very much, Mr. Chulani. Clearly, we're